Joining us today for another episode of our Market Thinkers series is Lee Levy, Senior Managing Director at Kayne Anderson. Welcome, Lee.
Thanks for having me.
Lee, can you provide some background into your career and what led you to joining Kayne Anderson?
Sure. Again, good to be here, Drew. I've been in the commercial real estate debt business for my whole career, so a little over 20 years. Pre-financial crisis, when times were good, to during the financial crisis and post-recovery. So I have a good experience of the run-up to the GFC and then restructuring, loan workouts, distressed investing. Ultimately ran a business at a big investment manager before joining Kayne Anderson, really with the idea of being at a firm that's more entrepreneurial, more of a real company culture. Our CEO and our CIO are incredible leaders and investors, and I felt that it was a great next step in my career to be a part of Kayne Anderson.
And we've talked about a lot of different asset classes, and commercial real estate debt is defined, I think, slightly differently or understood slightly differently here in Australia. Could you explain in simple terms what commercial real estate is and the debt part of it as well from a US perspective?
Sure. Yeah, so the simplest way to think about it is commercial real estate in the US is every asset class that's not single family homes.
Yeah.
So it gets a little bit confusing because something like multifamily or apartments is considered commercial. So again, anything that's not a single family home is considered commercial real estate, and debt is just how the asset's capitalized. So in most markets, real estate will be capitalized with a combination of equity and debt, and what we focus on, and debt providers like us focus on, is the debt portion of the capital stack, where the equity provider is subordinate capital to us.
And construction finance has been quite prevalent here as a form of commercial real estate debt. Can you talk about the different types of commercial real estate debt you operate or lend or structure in the US?
Yeah, I think about sort of transitional real estate and then kind of stabilized real estate. Stabilized real estate will typically get financed with long-term debt, fixed rate debt. If you think about real estate debt,
existing assets,
cash flowing, building with a full rent roll. So tenants tend to borrow, or real estate owners tend to borrow floating rate debt when they're doing transitional real estate. So it may be construction, but it may also be a lease-up play. It may be a value-add play, renovation, repositioning. Right. The building we're in now may or may not have been originally office. It may have been an alternate use. And so real estate borrowers will borrow floating rate money for a short period of time so they can access that transition, complete the business plan, and then either sell the asset or refinance it.
And Kayne Anderson focuses within this area?
We do. So, and this is really broadly speaking, think about, bridge lending as sort of a, short-term lease up to stabilization. Then you have what I would call like renovation reposition type of financing, where you're taking an asset and you're doing some sort of value add component to it through a capital improvement or changing its use. And then maybe the third piece would be ground up development. And so Kayne Anderson looks at all three sectors.
And we talk a lot about passive and active management within our portfolios. Given this is quite a niche area, I'm assuming Kayne Anderson focuses on it because there's the ability to know it better and extract better returns or more consistent returns.
Yeah, that's right. So in general, we tend to focus on four main asset classes: seniors housing, student housing, medical office, and multifamily. And the idea is that really the first three, senior, student, and medical office, are all really demographically driven asset classes, operationally intensive. They tended to be asset classes that were overlooked by some of the larger real estate players. And so we very early on in our the life of Kayne Anderson figured out and built a real estate platform around those operational capabilities. So we can own, operate, manage, and finance those assets very effectively because of our in-house capabilities.
In Australia, fixed income and kind of lending isn't quite as well understood. It's probably still, it's growing, but it's quite cottage. Could you explain what some of the biggest risks in commercial real estate debt are that investors should be looking out for?
I think in general, investors should focus on really three things. Best in class sponsors. So it's really important who the owner of the real estate is in terms of being able to execute that business plan. I think the leverage points should be moderate. You've seen people get hurt in the past when they've over-levered assets.
Like a loan-to-value ratio,
Exactly, a loan-to-value ratio that's moderate and manageable. And then I think the asset classes you pick are very important too. There's a lot of talk, certainly in the United States and in other major markets, around office as an asset class and the destruction of value we've seen post-COVID. We don't focus on office. We focus on medical office, seniors housing, student, and multifamily. So I think picking the right sectors. We talked about commercial real estate being everything but single-family homes, but even within commercial real estate, you really want to focus on asset classes that you think have long-term growth, that have stable cash flows, and that are defensive in nature. So if the capital markets or the macro environment changes, your real estate values will hold up over time.
From a retiree's perspective, so a lot of clients listening to this are retired looking for income, and then naturally a lot of their risk is coming from equities.
Sure.
What are the benefits, and why is commercial real estate debt so attractive for a retired investor or someone relying on it?
Yeah, it's almost like a fixed income allocation, right? Yeah. So like you'd have a stock portfolio, and depending on where you are in your age and your investment horizon, you'll have some mix of equities and debt.
Yeah.
So real estate's no different. You can have exposure to the equity part of the real estate capital structure through the capital markets, through private closed-end funds, or you can access the real estate credit markets, which aren't as easy to access in the public markets. People tend to do it in the private markets. But just like the stock and bond analysis we talked about, real estate debt is typically first lien, right? So first priority. You have a fixed income, right? So your upside's capped, but your downside's limited because your first lien contract income. So I think it makes for a good, product for people who are looking to match, I don't know if it's assets and liabilities, but matching their incoming fixed income cash flows with their fixed expenses, hopefully, right? As you're thinking about you're going to spend the next 20, 30 years of your life when you're out of your major earning years.
When it comes to income and the yield expectations from this sort of asset class, where does that sit?
In today's market, I'd say it's high single digits to low double digits.
Excellent. And one of the issues we've seen in Australia is there are a lot of direct mortgages, and these direct mortgage groups are growing, and then smaller subscale managers. So I'd be interested to know how what you suggest people look for when picking a manager, meaning including yourself.
Sure. Look, I think there are managers out there that are in the asset allocation game, right? Trying to grow AUM as large as possible. I think that can tend to lead to unnatural things to do as an investor. So you really want to focus as an investor giving money to a GP. You want to focus on GPs who are really focused on risk reward, on delivering the right returns to the investors as opposed to generating fees through AUM. So I think it's really important to do your diligence around the management team, around their track record, and of course, like what their focus is, because a lot of managers have tended to grow big over time and have become sort of a beta player, if you will. So what's important to you as an investor? Do you want to focus on a sector that's really important or an asset class that's really important, or do you want a broad-based exposure? And I think that will help you narrow down your list of managers.
And Kayne Anderson has a close relationship with Apostle Funds Management here in Australia.
Mm-hmm.
For clients listening at home, Apostle helps in kind of spreading the word about investments like Kayne Anderson. Could you expand on the value of that for your relationship as a US-based manager?
Sure. We couldn't attract capital in Australia without them. They're really an extension of our team. We work very closely with them on creating products for the Australian marketplace, and they really act as a group that can speak to Australian investors on our behalf and then come together in moments like now when I'm in town to be able to meet those investors face to face. We need that Apostle team to help create that product and bring us together.
Lee Levy, thank you.
Thank you. Good to meet you.